So our next testifier is Tom Francis, Director of the Oil and Gas Research Fossil Free Indexes.
Thank you.
Thank you.
Mic on? Okay,
No,
so
I-
I'll try to
Okay.
stick to my comments and a bit quickly, but I'm going to focus on.
If you
Sure.
can speak up, thank you.
I'm going to try to focus on, or I will focus on, the composition of the Carbon Underground 200, as well as some of the issues or costs and benefits of divestiture. And I choose is a bad word. I maintain the list of the 100 oil and gas companies that are on the Carbon Underground 200. I have a colleague who does the coal side, and so I'm most knowledgeable about the oil and gas. The first thing that I'd like to say is that divesting from fossil fuel companies while enjoying the electric lights and the comfortable heating and the driving to work each day is not really a hypocritical situation. It really is a recognition of our reliance on fossil fuels, and that it has to change. It can't continue as it is right now. It also insulates New York State investments against the decline of an industry that's shown that it's unlikely to adopt as global energy policy evolves. So in talking about how companies get onto the Carbon Underground 200, it's tempting to think of it as the largest oil, gas, and coal companies in the world, but that's actually not the case. It is companies that hold the largest amount of reserves. And to understand the list, it's important to make a distinction between burning fossil fuels and actually amassing inventory of fossil fuels. The current proven reserves for globally are about 100 times the annual run rate in terms of carbon dioxide, meaning that we could run, if we were going to emit the same way we're emitting right now, current stocks would last for 100 years before they would run out. It's different for oil, gas, and coal, but as a blended product, it would be about 100 years. So we can continue, according to science, if we want to avoid the worst consequences of global warming, we can continue emitting at the current rate for about 20 years. But then we have to stop flat. And that seems like a very unlikely path. I don't think we're going to be doing that. So fossil fuel companies hold about 4 or 5 times the inventory that can safely be burned. And yet they continue to invest in searching for more inventory. And I think that's one of the big problems that you'll be addressing with this bill. So global warming has already cost the state of New York a significant amount of resources. One of the questions I'm wondering is whether it's prudent to continue investing in an industry whose current inventory is likely, if it's actually exploited and burnt, is very likely to threaten the state's financial stability. And I think you're speaking to that today. But why don't I talk a little bit about what companies are on the Carbon Underground 200, because I think it can be easily misunderstood. On the way in this morning, I stopped at a Gulf station on the Pike and filled up my tank because I drove here. Gulf is not on the Carbon Underground 200 list. Neither is Sunoco or Phillips 66. These companies are refineries. They don't hold fossil fuel reserves. They buy their crude oil in the market and refine it into products that they sell. Those companies are not on. ExxonMobil, Lukoil are on, but they're joined on the list by shipping giant Maersk and also ArcelorMittal, the world's largest steel company. So divesting from the Carbon Underground 200 is not simply barring investment in the energy sector. There's lots of the energy sector that is still available to the pension funds. Also, the criteria, and I say criteria because it would be easy for me to say that I choose the companies, and I don't. I manage the data, I manage the process. The companies end up on the list because of the scientific basis of converting their fossil fuel reserves into carbon dioxide emissions, potential emissions, because they haven't been burned yet. But it is a significant amount of potential emissions. So the Carbon Underground 200 provides a disciplined approach. It's a tool for a disciplined approach to divestment. It's repeatable, it's science-based, and I think very effective. So I'd also like to talk about the costs and the benefits of divestiture. As Toby had mentioned, fossil-free indexes created a divested version of the S&P 500. Its name is FFIUS. You can get a quote at any financial website and a chart. I would have brought a chart, but it's pretty much identical to the S&P 500. We looked at the index over 10 years for daily returns, and there is no statistical difference between the two indices. So they look like two lines superimposed for the most part that jaggedly kind of move up. So in the last, as Toby had mentioned, and I don't normally point this out, but Toby mentioned FFIUS has outperformed the S&P 500 in the last 18 months or so because of the turmoil in the oil market. But let's see, we looked at 10 years. We chose the 10 years by when we formulated the index and rebalanced the history. And over the 10 years of daily returns, there were booms and bust periods. During those periods, there was still no statistical difference between the daily returns. So my point being that a divested portfolio does not need to be a underperforming portfolio. They can perform just as well, and it depends really on the portfolio. So I don't want I'm not suggesting that the state would suffer inferior returns. Finally, for the benefits of divesting from fossil fuels, the reserves that I'm talking about as inventory are assets on the books of Carbon Underground 200 companies, and they're very substantial assets that are used as collateral in commercial lending, and banks that cater to the industry will review those assets on a twice-a-year basis to make sure that they are maintaining their value in comparison to the loan portfolio that they're collateralizing. And as we've said, about 80% of current fossil fuel reserves can't be burnt if we're going to avoid the worst consequences of global warming. When those assets lose their value, the companies that hold them will also lose their value. And the losses will not be distributed equally. As it happens, Carbon Underground 200 companies are public companies with access to capital and the ability to hire the best employees, most talented employees. They really address the most high-cost and high-risk projects in the fossil fuel industry. And so these companies are really at most risk for stranding in terms of their reserve assets. And that risk should be taken very seriously. So in closing, I'd like to just stress 3 points. First, that divesting from Carbon Underground 200 companies does not mean selling all of your energy sector holdings. Second, divesting from the Underground 200 does not imply inferior portfolio returns. And finally, the Carbon Underground 200 companies really are a substantial risk in terms of devaluation because of global energy policy. So with that, I will thank you.
Thank you very much.
Thank you.
And take any questions.